Hey everyone, and welcome to The Explainer. So you did the smart thing. You built a portfolio with a bunch of different ETFs because you wanted to be diversified, you wanted to spread out your risk. But what if that diversification is actually just an illusion? We're going to dig in and see if your investments are all just different versions of the same thing.
Let's talk about a hidden risk that, honestly, a lot of really smart investors miss: portfolio overlap. You might think you're holding this nice, varied basket of assets, but in reality, you could be doubling, maybe even tripling down on the exact same handful of stocks. And what does that mean? It means if those few companies take a nosedive, your whole portfolio feels it way more than you'd ever expect.
Okay, imagine this. You're hosting a potluck, right? The whole point is to get this amazing variety of food from all your friends. You're thinking salads, appetizers, all kinds of main courses, desserts. You're expecting this incredible, diverse spread on the table.
But then everyone starts showing up, and you look at the table and you see nothing but lasagna. Yeah, sure, maybe one's a meat lasagna, one's veggie, another one is just cheese, but at the end of the day, it's all lasagna. That amazing variety you were dreaming of? Poof, gone. Well, this is exactly what can happen inside your investment portfolio.
So, this lasagna problem, as I like to call it, actually has a real name in the investing world: ETF overlap. Let's break down what that means, and more importantly, why you really need to know about it.
At its heart, ETF overlap is pretty simple. It's when you buy different funds that, when you look under the hood, actually own a lot of the same stocks. So you think you're buying a salad and the dessert to go with your main course, but you've really just bought 2 more trays of lasagna. And this creates what we call unintended concentration, and it just completely undermines the whole reason you were trying to diversify in the first place.
Now, here's a really important point. The goal is not to have zero overlap. I mean, that's almost impossible and probably not even a good idea. The key, the thing we're really talking about, is managing excessive overlap. The kind that can quietly turn your well-thought-out portfolio into a massive bet on just a handful of companies.
Let's make this real. Take a look at this. On the left, you've got a standard S&P 500 ETF, and on the right, you've got a tech sector ETF. You might own both, thinking, great, I'm covering the whole market and I'm making a special bet on tech. But just look at the top holdings. See that? Apple, Microsoft, Nvidia, they're dominant players in both funds. So instead of diversifying, you've actually just loaded up even more on these same tech giants.
So the big question is, how do you find these hidden lasagnas in your own portfolio? Well, the good news is it's actually way easier than you might think. You just need to put on your detective hat for a little bit and do some digging.
All right, here's your 3-step game plan. First, just do what we just did. Compare the top holdings side by side. That'll tell you a lot right away. Second, zoom out a little and check the bigger allocations. If both your ETFs are 25% in technology and 90% in the US, well, that's a pretty big clue. And third, use the tools that are out there. You don't have to do all this math yourself. Most brokerage platforms and financial websites have free overlap calculators that do all the heavy lifting for you.
Okay, and when you're doing your analysis, this is a super important distinction to understand. You have unweighted overlap, which just tells you which stocks are shared. It's like counting the common ingredients. But weighted overlap, that's the one that really matters. It tells you how much of each shared stock is in your ETFs. It actually weighs the ingredients. And that is by far the most meaningful measure, because it shows you where your money is really concentrated.
All right, so once you've played detective and you've found the overlap, it's time to switch hats. Now you get to be the architect and actually build a stronger, more truly diversified portfolio.
So here's your blueprint. First, think in terms of complementary pieces, like a US stock fund, an international stock fund, and a bond fund. Each one does a different job. Next, avoid redundant funds. You probably don't need 2 different ETFs that both track the broad US market. And also understand that some overlap is okay and even expected. Of course, a tech fund is going to overlap with the S&P 500. It's all about aiming for a portfolio that's balanced, simple, and cheap to own.
Which, brings us back to the most important question here, the one we touched on earlier. Does all this mean you have to go on a crazy mission to hunt down and eliminate every single tiny bit of overlap?
No, absolutely not. Let's be perfectly clear on this. The goal is not zero overlap. The goal is to be intentional. It's about avoiding excessive overlap that secretly wrecks your whole diversification strategy. It really just comes down to knowing what you own and, more importantly, why you own it.
So I'll just leave you with this one question. What hidden lasagnas are lurking in your portfolio? Are you actually serving up that diverse potluck of assets you planned for? Or is it maybe time to adjust the menu? Taking a few minutes to check is the first and honestly the most important step to becoming a much smarter and way more successful investor.